Hello, welcome to revision tips for CIPS Level 4, Diploma in Procurement and Supply. This is Module 2, Defining the Business Needs, and it's Learning Outcome 1, which is to understand how to devise a business case for requirements that are going to be sourced from your external suppliers. We look at things like how business needs influence our decisions, how cost and price can be estimated, the criteria to apply to a business case, and interpreting financial budgets for the control of purchases. So business needs are the inputs and things that a business needs in order to deliver its objectives. Some of these things will be very similar to most businesses. For example, they all need facility support services, a way to advertise what they sell. And other elements will be different and specific to the type, size, and complexity of the business. As such, it's important that a procurement person understands not just the markets within which you operate, but also have a really clear view of your business, its financial position, and the objectives it's trying to achieve. Meeting input needs involve achieving the 5 rights of procurement. And procurement role is basically to provide the right inputs to meet the needs of the business. But every procurement we approach isn't going to be the same. There are 3 types of business needs: a straight rebuy, a modified rebuy, and a new buy. With a straight rebuy, the purchase is something that an organisation has bought before. So the business needs have already been defined and specifications generally are already in place. The suppliers will be contracted to agreed terms and conditions, and the procurement task is probably just to raise a requisition or a purchase order. With a modified rebuy, it's similar to the straight rebuy, but there are some changes to the specification. So the business need will be revisited, particularly if part of the cost reduction needs to form part of the programme. So procurement's task will be to create the sourcing strategy and decide on the route to market. Then decide how to implement the new arrangements and how to track the results and benefits, as well as to define the trigger events that will restart the sourcing process. But what about the new buys? This is made when an organisation identifies a completely new requirement that's never been purchased before. So our task here is to understand the business requirements completely, write the specification, research the market, and decide on the key capabilities our suppliers must have. Write the tender and manage the process, negotiate and select the supplier. So clearly the new purchase will involve many more people from different departments in order to mitigate the risks to your organisation. So what do we mean by a business case? So for large-scale procurements, a formal feasibility study with a cost-benefit analysis or a business case may be required. And your procurement policies will often state when these are required. For example, it must be presented if it's over a certain value. But typically, a business case will need to demonstrate the activity is consistent with your strategic objectives and how its intended activity will meet or benefit the need of the business. So for procurement, that could include increasing competitive advantage, reducing lead times, or even cost reduction. But essentially, it aims to gain approval for a project or activity that requires significant commitment by clearly demonstrating how it meets the needs of the business or its business benefits. And here are just some examples of the implications of the 3 types of purchases that we discussed before. So compare the level of effort required with a straight rebuy and the potential level of effort associated with a new piece of highly expensive equipment. Organisations will have lots of experience in buying straight rebuys, but not much experience in a new buy. Relatively little information is needed with a straight rebuy, whereas buying a business critical piece of software will require extensive information. And public sector purchases are generally driven by clear guidelines that could have implications for any of these. A business case is a justification for undertaking an action. Its purpose is to seek approval and possibly finance for the recommended action plan. It should clearly identify the opportunity it seeks to exploit or the problem it's looking to solve, the benefits of that action, any risks and how they can be mitigated, the timescales for completing the project, the roles and responsibility of who's involved, and why something needs to be done, not just what needs to be done. So in procurement, a business case is prepared for a number of reasons. When a contract is coming to an end and the product or service needs to be reprocured. When cost reductions need to be made, which require change to the way the business operates. But it will include an exec summary, what our long-term strategic considerations are, the business need, why do we have it, the cost analysis, what's going on with the market and suppliers, any advancements from a technological or innovative point of view, any vulnerabilities, sourcing objectives, our chosen implementation plan, and the competitive advantage it will deliver. The business plan should enthuse the senior managers and directors and describe how the proposal will impact the things that are important to them, such as return on investment, time to market, or even improved productivity. So next we're going to look at some market data, and gathering information is not an end in itself. We gather information to enable us to become more knowledgeable. So more knowledge about what the business needs are or how they can be effectively and efficiently met. And we do this for things like benchmarking, pricing trends, or looking for new market entrants. And there are some sources of market data that are key to ensuring that the sources are relevant and reliable. So for example, we need reputable marketing agencies or trade sector sources. But do remember that information is power, and gathering that will help us to be more knowledgeable and better at meeting our business needs. Market research can be extensive both in time and money, but no purchase should be undertaken without some kind of market intelligence. Formal market research is more appropriate for strategic and important procurements. Now, primary research, also referred to as field research, is undertaken for a specific purpose, and the research is acquired directly from the relevant source. So an example of this would be a supermarket chain gathering primary data directly from its customers using a questionnaire. Secondary research makes use of the secondary data that's already been gathered for another purpose. So in essence, it already exists. So sources of primary data include questionnaires, interviews, observations, and focus groups, whereas the secondary one includes trade presses, the internet, websites, and published research reports. There are advantages and disadvantages of both. Clearly, one takes longer than the other. One's quicker, one's cheaper. Okay, now two commonly used terms in market research are qualitative and quantitative research, often abbreviated to qual and quant. The qualitative data focuses on numbers. Sorry, the quantitative data focuses on numbers. So an example of a quantitative data is 85% of people we asked said X. The qualitative data focuses on things like thoughts and feelings and opinions. But to focus on the role of purchasing, the research we need to look at and the sorts of things we'd engage with might be to do a RFI. So RFI stands for Request for Information, and the main thing to note about the Request for Information is it is just that, it's information. They don't promise suppliers any contracts or orders, but they do offer a way of gathering information about the market before you actually go to market. So you're gathering information from your suppliers. It's quite early in the process, and what you're doing is testing to see how much competition there is, how much interest there is in your project. When estimating costs, there are different categories of costs to consider. You've got the directs and indirects, fixed and variables. We're going to start with direct costs. which are often attributed directly to the production of a specific unit, good or service. So an example of that would be the raw materials, the sub-assemblies, ingredients or consumables that go into manufacturing a product. Indirects, on the other hand, are also referred to as overheads. Indirect costs are all the other costs of those that cannot be measured directly in relation to each unit produced. So it's basically your back office costs. Another way of looking at costs is to look at fixed and variable. Fixed costs are the costs that stay the same even though the volume of activity changes. So these fixed costs will be your indirects, whereas the variable costs are the ones that will vary depending on the volume. These are your directs. And this is a really nice way to summarize a sort of manufacturer's operating costs. You've got your direct costs on the top left, your indirects on the top right, the sort of overheads, everything sort of, you can add all that together to get your total cost base. Now, two ways to produce estimated costs and budgets is break-even analysis and purchase price cost analysis. The break-even point, which you can see on this slide, is the point where the lines cross over when total cost and sales revenue are plotted on the same graph. It's the point where the sales revenue value is equal to the value of the costs. So knowing your supplier's break-even point can be useful when entering negotiations with them, as it tells you what their lowest price is likely to be. Purchase cost analysis is used to analyse the cost of purchasing, so strategies can be developed to reduce the cost and maybe improve the supplier relationships. And many of us are aware of situations where we're asked to have a good look at costs so that those costs can be lowered. Now, lowering costs can help improve profits, or for many organisations, actually enable a profit rather than a loss. And as we know, public sector they don't make a profit, but they are frequently under pressure to reduce the cost. Third sector organisations, like charities, will also make something known as a surplus, which helps the beneficiaries. They still need to reduce costs where they can. So the process will be to benchmark the purchase price against comparators to determine if it's fair. The three sources of price comparators are prices that you've paid in the past, so long as those prices are adjusted to account for inflation or deflation. You've got published prices such as those found in catalogues, or using a price formula. So the cost to build an office would be benchmarked at a certain price per square metre. Now, CIPS refer to the aspect of purchase cost analysis being to think about the type of relationship the business has with its suppliers. And this could be extended to also include thinking about the type of relationship the organisation wants to have with its suppliers. Reducing costs in a way that considers the current and future relationship with their supplier could actually improve that relationship. And now we're going to look at the Kraujek matrix, which is a useful way of prioritising which purchase costs to analyse. So this is the Kraujek matrix that's been amended to some sort of segmentation model. And it considers the nature of the purchase, whether it's ongoing or one-off, and the desired relationship with the supplier. Do you need an arm's length relationship or some kind of partnership, strategic alliance? It produces the four quadrants: leverage, strategic, low impact and critical, which I guess are usually routine or bottleneck. Now, if an arm's length organisation needs a leverage purchase, the organisation can use cost, eliminating and value analysis. Competitive bidding can be used to compare prices by using the market competition to obtain each supplier's best price for comparison. And where a strategic alliance is required, buyers should work closely and cooperatively with their suppliers to find ways of reducing the cost to achieve the target cost. So you can look at things like lifecycle costing and total cost analysis. So lifecycle costing So there's an important difference between purchase cost of an item and the life cost. There are three phases to a total life of a product or a service: the pre-production, the production, and the post-production. And there are costs associated with each. So pre-production costs could include research, development, and setup. Post-production could include decommissioning. And other costs over and above the purchase price could be things like the cost of finance, the delivery, installation, and commissioning cost, the transactions, foreign exchanges, operating costs for spares and servicing, storage costs, quality costs for inspection, reworks, and end-of-life costs, which includes decommissioning, removal, and disposal. So whole life costing is also known as life cycle or through life costing. There are four methods business cases tend to use to evaluate investment opportunities. So you can go to accounting rate of return, the ARR. There's the payback period, net present value, internal rate of return, and discounted cash flow. So do have a look at these on YouTube and just have a look at how these investment appraisal methods work. So when evaluating a business case, do check for the following. Is it clear what the objectives are? Issues management considered three potential sources of information to determine whether an objective is strategic or not. So it looks at things like the external trends, performance trends, but also the internal trends. Does it reflect a real and legitimate business opportunity or problem? The 5 whys can be used to test whether or not an objective represents a real opportunity. So keep asking why to delve deeper and uncover the true underlying issue. Now, the business case should show that a number of options have been considered to reach the objective before selecting the best one. Strategy options can be generated by using brainstorm techniques with peer groups. It's possible to benchmark similar strategies used by other organisations. Hybrid strategies can be developed by comparing features of existing strategies and combining them to form new ones. And the cost benefits analysis will compare the costs with the benefits of each of the options that have been presented, as well as the risks. So you add up the financial benefit of the option, subtracting all the costs associated with it. And some strategies can be considered and even adopted for reasons other than commercial ones, which is particularly true in in the public sector, where there might actually be a political reason to do a specific option. But the value of the cost-benefit analysis in this case is to show the financial consequences of the choice that you're making. Risk assessment selection shows the major risks that have been considered and the actions to take to eliminate them. And then an implementation plan covering things like whether roles and responsibilities have been allocated and agreed, the suitability of the communication strategy, whether there is a change management strategy, whether the specification and procurement route has been agreed, and the time allocated for key tasks such as writing tender documents, negotiating and writing contracts. So we've talked earlier about the need to see problems as opportunities, and here we are looking at whether or not business case objectives offer a way of taking advantage of an opportunity or solving a problem. Again, within the public sector, objectives may reflect a political mandate. So issues management is a way of assessing whether objectives are important enough. We're often faced with different ways to achieve an objective. And that can be seen as positive. It gives us options, and options gives us choice. But if we have generated and then systematically considered a number of different variable options, we are more likely to be effective. Think about something you've debated buying. Let's say a new car. The car you wanted was going to cost you £25,000. So the benefits would include things like more reliable transport, stylish, saving the cost of constant repairs. But do the costs outweigh the benefits to you? Cost benefit is relatively simple exercise for deciding whether or not to take forward an action. But here is a list of possible benefits. And these are based on a commercial organisation where public sector organisations may need to consider benefits associated with, I don't know, social outcomes, for example. So the benefits could be the fulfilment of an objective, better revenues, reduced costs, better profitability, or value for money, better shareholder value, competitive advantage, or being able to leverage your key resources, increasing your capability, capacity, or flexibility, and improving your brand reputation. But now we need to consider the risks. Not all risks can be removed, but we can aim to mitigate as many as possible. And a business case should identify risks and consider which can be and should be mitigated. So the assessment is actually the process of just identifying what might go wrong. Having identified the risks, the next stage is to assess them in terms of how likely they are to happen, which is known as probability, and the impact if they were to happen. You can use a scale that, like you can see on this slide, from very low to very high, or and essentially look at the probability versus the impact and plot it onto this graph. Clearly, the ones in the top right area are the ones that you should concentrate on dealing with, rather than those in the bottom left. So risks on the top right-hand corner are very high. They're risks that are too large that an organisation should be trying to continue with. So it could be a health and safety risk or a compliance issue. These risks will need to be terminated if the impact or probability cannot be reduced. If you're in the bottom left corner of the grid, essentially these can be tolerated. They may require ongoing monitoring to check whether the risk status has changed. And risks in between can either be transferred or treated. Which leads me on to the risk mitigation strategies. You've got on the left-hand side the ACAT model, ACAT, and on the right-hand side you've got the 4Ts approach by Sandgrove. So ACAT can be a useful mnemonic to help remember potential mitigating approaches. So you can either avoid it, control it, accept it, or transfer it. The 4Ts is similar words, but do you tolerate, which again is to accept, transfer, you terminate it, which is to avoid, or you treat it, mitigate or control. The focus for CIPS is on the 4Ts, although there are considerable alignments to the 4Ts and the ACAT model. These models can be seen as other potential responses to risk. To go back to the business case, the financial budget often manages a way of monitoring actual versus estimated costs. And that way, check what there has been promised on the business plan in terms of cost versus benefits being achieved. But variances need not only be financial. It could be schedules, timescales, output or quality. And we tend to think of variance in terms of going over budget or estimates. We will certainly need to take corrective action, but positive variances could also be investigated. Now, the Chartered Institute of Management Accountants said budgeting helps all types of organisations to plan and control their operations and support their managerial strategies. And the budget sets out the benchmark against which performance will be measured. And the main purpose of the budget relates to planning and control and supporting the achievement of strategic plans. Variances from budgets need to be identified so that the relevant managers can be notified and appropriate action taken. But not all procurement professionals are involved in setting and managing budgets. Traditionally, this is done within the finance department. If this is the case for you, look to spend some time with your finance colleagues so that you can understand how this works and can talk about it with the procurement department that feed into this. Our budgets are often set on the basis of what happened last year, with some adjustment for an expected forecasted sale. This approach is known as incremental budgeting. Zero-based budgeting works on the principle that all spending needs to be justified. So we do not assume that we should finance the future based on the past. So just because we spent 20,000 on training last year doesn't mean we should expect to spend 20,000 this year. The budget will need to be reset to zero, and it will only be increased if a good case is made for the expenditure. Zero-based budgeting encourages managers to adopt a more questioning approach to their area of responsibility, to justify the allocation of resources, and managers are often forced to think carefully about the particular activities and the ways in which they're undertaken, and conclude that the questioning approach should result in a more efficient use of business resources. Fixed budgets are based on a particular activity, such as producing 30,000 items, and a flexible one is designed to change as the volume of output changes. So a financial budget is a plan of how an organisation or department proposes to raise income and then spend it. It helps an organisation see what funds it will have to meet the obligations and whether there'll be sufficient surplus funds to reinvest in the business. The plan do review cycle is used to manage a budget. So firstly, you develop the budget based on the business case that's been approved. So that's your plan phase. In the do phase, you monitor variances and take the actions. And in the review stage, you evaluate the budget performance and you replan. So in order to prepare and manage the budget effectively, it is necessary to understand what cost entries apply to the budget and how they will be impacted and have an impact on the organisation's cash flow. So here we can see an example where there is a delay between revenue and cost. So the cash flow cycle shows the raw materials have been received, manufactured products, stores and inventory, pays suppliers, then sells the products and receives the fund from the customer. But there's quite a lapse between when you're paying for the raw materials and receiving the funds from your customer. Accruals is an adjustment made to the accounts to match costs of revenue in the same month. And in accounting, revenue in a month should be matched with the cost in the same month. And the amount used is a cash flow calculation of the actual amount that enters the bank account that month, excluding any accruals. The value including accruals is the one that is used to record revenues in a profit and loss account. The same applies to direct costs, so purchases from suppliers will have to be made on the credit. And that's so that not all of them have been paid at the month end. The value of the items that leave the bank account is used for cash flow, and costs are adjusted by accruals for profit and loss. Overheads are split. Internal costs are paid to the accounting period of the month or the year, so no adjustments are required, but the rest are items consumed in accounting periods but not yet paid for, treated as accruals for profit and loss purposes. Large assets are used as machinery or office furniture over the last few years. The full purchase price will be reflected in the cash accounts at the point of purchases, but in the accounts, a proportion of the cost known as depreciation can be allocated to each year that the asset is expected to last. The depreciation amount is used for profit and loss. And then bank loans generate cash for the organisation at that point of drawdown. They're counted as cash in that operating period. So businesses do need to keep cash circulating in the same way that humans need to keep blood circulating in their system. So it is, for example, important to ensure cash coming into the business when it's due and that the business doesn't have too much stock sitting in its warehouse. It can be helpful to think about cash flow. You know, have you ever deferred a purchase you didn't want to be overdrawn before you got paid? Overdraft are expensive forms of credit, and the same basic principles apply to a business. Thank you for watching.